Hello, everyone. Welcome back to another episode of the Weekend Charts. Charlie Bilello here, and back with me once again, Jamie Battmer. Jamie, a lot to talk about going on in the markets. We have the situation in Iran. We're going to run through all that more. If you guys are watching this on YouTube, take a quick moment, hit that subscribe button for all the latest content from us. What are we going to be discussing today? We have to talk about Iran. Everyone's asking this question, what happens next? Jamie, you and I will kind of discuss some of the different scenarios that could play out over the next few weeks, next few months, and hopefully not next few years. We'll discuss that. Why have stocks been so resilient? We'll talk about that. There's a couple different theories. I'll give you mine. Is the U.S. consumer in trouble? There's some growing signs here. People debating, is this just a blip here? Is it something more? Forget about rate cuts. That's my view, Jamie. You could take the other side if you like.
Right.
I don't think the Fed is cutting rates in the next few meetings, and maybe even more. And we'll end with something positive, as we always do, and that would be falling homicide rates within the U.S. Let's start out here with Iran. What happens next, Jamie? Here's a few different scenarios. You tell me which one you think out of these is the most likely. We have a swift transition here. That's really the most optimistic scenario. Maduro situation like we had in Venezuela, where perhaps the replacement is somebody very close to the existing leader who was taken out. The regime weathers the storm and we have a drawn-out fight over the next few months or perhaps longer. Or you just have really the worst possible scenario. There's a civil war and chaos reigns. I know this is an impossible question to answer, but what do you think is most likely here?
Well, thanks, Charlie, for bringing me on another episode for the easy ones to answer. Joking aside, of course, it's a tragedy, the human suffering we're talking about. We're going to end it with the lower homicide rates. This is, accelerating it. The only outcome we can talk about is that no one knows what the outcome is going to be. I mean, since the dawn of time, leaders, militaries have been completely surprised about the outcomes that were never a part of their war planning, their war games actually came to manifest itself. So trying to pick how it is, it's far too fluid of a scenario. All I'll say is, my dad, the first airplane he ever got on was flying him to Vietnam in the mid-1960s, and everyone thought they were going to be back within 6 months. And well, more than, effectively 10 years later, right, we're abandoning Saigon. And so these things always have a way of not working out as necessarily planned. So very, very difficult. Not even going to attempt to say what the outcome is. No one involved knows what that's going to be yet.
Sure. I guess, the fear is that this gets drawn out. It's another situation like we had in Iraq where people thought it was going to be a situation that would be resolved in a few weeks, a few months. And after Saddam Hussein was eliminated, we thought that the end would be closely thereafter. And of course, that didn't play out. I guess really the big question, Jamie, which is unanswerable, is what is the objective here? What do we view as winning? And if winning is a new leader that we like and that we want in place, well, how do we ensure that happens without putting boots on the ground, without a prolonged struggle? I'm not sure how you accomplish that without a longer fight here.
Yeah, it's completely impossible to foretell the outcome. Completely unactionable from an investment standpoint. What we can control, really what we can do is, as markets adjust, as markets react to this, there's the opportunity, but that's a reaction to what the markets are giving us in order to act upon, instead of trying to foretell the future that, leaders of Iran, leaders of the United States, that their crystal balls are equally foggy, and a lot of variable outcomes here, totally unactionable from an investment standpoint.
Sure. Even if we said this is going to go on for years, similar to the Iraq War, which started in early 2003, if you would have thought that would have pushed the market lower, the exact opposite happened as if you go back in history and look, the market rallied not because we were at war with Iraq. And I'm just pointing out that the two things could happen. You could have a scenario where the war goes on for a few months, a few years, and the stock market doesn't seem to be reacting, which is confusing for a lot of people.
Yeah, markets find a way of filtering through. A lot of great historical information on how the stock market did during our Civil War, right? And it would oscillate. These traders would be down there depending upon what the news came in from, where the advancements were, where the defeats were. And so markets find a way forward, and we've dealt with a lot of human suffering before, and markets they just find a way.
So let's talk about what's happened so far this week, Jamie, because I think this would surprise a lot of people, because you assume that there's going to be a pretty sharp move lower in the stock market in terms of this event. Now, we did see both crude oil and gasoline accelerate their moves higher. I say accelerated because they had been moving up in anticipation of something happening, some type of conflict. Maybe not this exactly, but you can see on the chart here, I put a vertical line when the attack on Iran started, and you can see the acceleration in terms of crude oil. It's now up over 40% this year, and gasoline futures up over 55%. But if you look at the S&P, only down less than 1%. It was up about a 0.5% at the end of last week. Not a huge reaction in the stock market. And I don't want to get into maybe why that is yet, because we're going to discuss that in the second segment here. But what do you make of the moves in crude oil and gasoline? This is also something that's very hard to predict. We saw this back in 2022 when Russia invaded Ukraine. We saw crude oil, gasoline prices spike to really their highest levels ever. Gasoline was over $5 a gallon at that point. Like, that took a few months to get there, and that, of course, fed into inflation and other problems. So I guess the big question for investors, Jamie, is how long do these things stay elevated? And is there a breaking point in terms of the level of crude oil? We went above $80 a barrel today. Is it $100 a barrel? Is it 120? Those are hard questions to answer, because I could point to different times in history when crude oil was at $100 a barrel and the stock market was doing fine, and other periods where it had difficulty.
Yeah, what's interesting, you saw back on that chart the relatively benign movement with the broader markets. It was part of that was this occurred over the weekend. We all had a chance to digest it some. This didn't happen at 10 o'clock on a Tuesday morning. That immediate response would have been much more volatile in all likelihood. But it's masking massive movements underneath the hood. That's why there's a real benefit for taxable dollars, the ability to tax loss harvest at the individual stock level, even if there's relative minimal movement at the broader index. It's just a very, very powerful weapon to drive stronger returns, bank those losses that can be used anywhere. But yes, the crude oil spike, really, Charlie, one thing interesting about that is, yes, a massive spike, obviously a huge amount of oil comes through there, but a dramatically lower spike in all likelihood than if this would have occurred in the 1980s or 1990s, because our dependence upon so much oil coming through that Strait of Hormuz, I'm probably mispronouncing it, is dramatically less than it was at that time. I saw something interesting that this is China is still pulling about 90+% of their oil through those channels, so much more of an impact on them potentially. But yes, it's a spike because there is this uncertainty. But this spike, when just like when the gas shortages, late 70s, when OPEC really came, they had a lot more power because the world, the United States specifically, was much more dependent on oil coming out of that region. And so yes, it did spike, but actually a lot less than would have if this conflict would have manifested itself in the prior decades.
That's an excellent point, because the U.S. crude oil production just continues to increase, hit record highs. We're now a net exporter of crude oil, and the U.S. exports more than anyone else in the world. So it's more complicated to say there are winners and losers, is what we're saying now in terms of this. And because the U.S. economy, there's many companies that benefit from higher crude oil prices because we're exporting them. And one way to look at that, Jamie, is simply look at the energy sector within the S&P 500. It's up over 25% this year. You see technology, which has been the leader for well over a decade, down a few percent, not a huge loss, but that's one way of looking at it. If you're in a diversified portfolio, you do have some exposure here embedded within the S&P 500 to companies that will benefit if crude oil stays high.
And this just reinforces diversification. We never know what the future brings when conflicts like this spike themselves, when there's this huge technological innovation like we're experiencing with AI. That's why you have more of your eggs in more different baskets. And flooding into oil now would be as silly as running away from it over the last decade or so as it underperformed. It all serves a purpose in a well-diversified portfolio and should be relatively weighted based upon the underlying companies in the indexes that are involved with oil, are involved with gold, or are involved with technology. And so we've seen this, the great reinforcement of the benefits of diversification. Last year, the exact same thing with international and emerging markets outperforming for the first time in a long, long time. So go running for it now? No, but don't run from it when it underperforms. And this underperformance can sometimes drag on for years and years and years and years. And like anything, you got to hold on just that much tighter when you just feel like you can't hold on anymore.
Yeah, you can't fight the last war and be successful as an investor. And we learned that most recently in 2022 when we had that commodity spike and oil spike. I think the energy sector, Jamie, was up over 60% that year. A lot of money flooded in, chased that, and then essentially it went sideways for 3 years. The money came out, and guess what? Now it's going back up again. So this is a cycle that's repeated over and over again. This is why if you look at sector-specific funds and you look at the flows and you look at the performance, investors tend to do the worst in these because they're just chasing recent performance, and you just see these rapid shifts from one sector to another, and investors want to be in that hot sector. Unfortunately, there's reversion to the mean, and if you're just chasing that hottest area, you're likely to time it in the wrong way. But I want to talk about the resiliency here, Jamie, because this is probably the question I'm getting most from people is we got all of this uncertainty. We just outlined many different things can happen with the conflict in Iran. Hopefully it ends very quickly and has a good ending, but we don't know. And that uncertainty, you would think, would have led to a bigger correction in the markets. Every year, Jamie, we have a correction. We don't know how big it's going to be. Almost every year you get a 5% correction. Most years you have multiple corrections of 5% or more. Last year, of course, we had the tariff tantrum, which was over 20% decline. We have that little AI bubble fear. People probably forgot about that already back last October and November. But S&P sitting here today down 3% from its all-time high. Yes, there's been more damage within that. And to your point, people should be looking at tax loss harvesting. If you look at the Mag 7 names, they're all down from 9%, looking at Apple, to 27% for Microsoft. And I've been talking a lot about the software sector, Microsoft being a big part of that. You see a lot of names they're down 30, 40, 50%. So certainly there's bigger losses underneath the market. But the S&P 500 down just 3% from its all-time high, given all this uncertainty of what might happen with Iran. What's going on here? How is that possible?
Yeah, markets just find a way. They're resilient, and different underlying instruments respond in different manners. And so some people would say, some traders would say, okay, there's some great opportunity here to buy some things at a discount. Well, there's a term, beware of trying to catch a falling knife, because when something's down, you never know how much farther it can go down. But for the prudent investor, again, this is the opportunity that, yes, it's relatively benign at the higher level, but proper tax loss harvesting always adds value to portfolios, regardless of what the markets do moving forward. Last April, right, with the tariff tantrum, as Charlie mentioned, down 20%, We did more tax loss harvesting in that early April period than any other RA in the industry. We had no idea the markets were about to recover and go straight up to the end of the year. No one knew that because the future forever remains unwritten. But this volatility has always manifested itself. It always, you know, appears in markets, right, to the tune of 14% on an average annual basis. But being unemotional, taking advantage of the opportunities that come out of this volatility, that's what we do for our clients all day long, instead of trying to pick the individual winners and losers. Recognize that there are always winners and losers. Last year, great year for the S&P 500. 200 of those 500 stocks were down. Chipotle was down 45%. Lululemon was down, about that as well. Those are literally my 14-year-old daughter's like two most favorite things in the world. So the Vivian Battmer momentum portfolio may not work, but the idea is, tremendous opportunity underneath the hood, and that's what volatility brings. And yes, although there's that limited volatility at the high level index right now, a lot of opportunity underneath the hood to take advantage of it, because it always have and likely always will be manifesting itself in markets. And volatility is just the inevitable price of admissions for stronger long-term returns. And focus on those tax benefits for any taxable dollars. If you're not doing that, it's the closest thing to missing out on free money that the markets are willing to provide.
Yeah, and what I would say about this chart is, and the S&P only being down 3%, it would not shock me or you, Jamie, to see us come back in a month or 2 months from now and see Iran being on this list and seeing some type of bigger pullback. So it doesn't have to happen this week. We don't know what the breaking point is in terms of investors getting fearful enough to sell, but it would not be shocking. It would be almost weird if it wasn't on here if this gets drawn out. So we're not saying by any means it's going to end here and the market's just going to rally back to all-time highs like it did last June, when we hit Iran for the first time. Just saying the opportunity at some point will likely come this year. If it's like most years, there will be a drawdown of some level. And when you're in the midst of it, it's going to feel like the end of the world. And then with hindsight, of course, we know it's never the end of the world. You have to believe that the future is going to be better and that whatever bad thing that's going on at the time is going to ultimately be resolved. But to me, Jamie, if I'm trying to explain, at least here and now, why investors really aren't panicking, is they seem to be betting that the earnings picture is going to hold up. That so far what has happened in terms of Iran, and I guess they're projecting that going forward, at least for now, is that won't be a meaningful hit or a hit at all to corporate earnings within the U.S. companies. And if we look at fourth quarter earnings, we're almost done with earnings season here. Pretty good. Once again, another all-time high. We're looking at a 13% year-over-year increase on a trailing month basis. The fourth quarter earnings were about 14% higher than a year ago. That's more than double the historical earnings growth. Pretty good in terms of the earnings picture. And that's a hard backdrop to push stocks down very much for very long.
Yeah, these exogenous shocks like Iran can push it down momentarily, but stock prices track earnings, and earnings continue to grow. That is nothing but a tremendous tailwind that has always tracked broader markets over the long run. It can be disrupted momentarily at any moment, but that disruption should absolutely not impact a well-diversified portfolio for a moment. You're just setting yourself up for, in all likelihood, making the exact wrong decision at the exact wrong time. And it's fear instead of fundamentals driving it. Focus on earnings. Earnings growth, as Charlie said, is very, very healthy. Take that as a very positive sign for stocks.
Yeah, and in the short run, this is just changes in sentiment. And if earnings hold up and they grow mid-teens, like many are expecting, and you get a market pullback this year of 10 to 20% at some point, well, then that's a gift to you because you're able to buy stocks at cheaper levels. The big question, Jamie, I think we're going to come back to this pretty shortly here, is what's going to happen here with AI and NVIDIA. I update these two charts every quarter. It just gets more and more ridiculous to look at. NVIDIA reported record revenues once again, 68 billion, net income 43 billion. Now it's the highest. Was already the highest market cap company. Now it has the highest quarterly earnings, but I've never seen a chart like this because there's never been a chart like this where a few years ago they were doing 3 billion a quarter and now they're doing 43 billion.
Yeah, I mean, they're at the epicenter of one of the greatest kind of quantum leap forwards we've seen that usually manifest themselves over every 25 or 50 years. And so as we're in the early innings of this, there's a lot of momentum behind it. And NVIDIA being the beating heart of this drive forward, it is amazing, but they're just at the core of this amazing technological shift that's occurring.
And they've been, to be clear, they've been the primary beneficiary so far of this wave. It's definitely helped tech overall, but that's really we're starting to see a divergence here, Jamie, between NVIDIA and everyone else in terms of they're reaping the lion's share, and many of these other companies, it's a big cost center for them if you look at CapEx spending. So if we look at Amazon, Google, Microsoft, and Meta, they're the big four players in terms of spending here. 376 billion is what they spent on CapEx last year. That was almost 4x higher than what they spent 5 years ago. It's a crazy increase. And the question that will matter for the US stock market, for investors, is are these investments going to lead to a high return on capital for these companies? And that the market is betting that the answer is yes, but more and more people are starting to question whether that is actually going to happen and when it's going to happen.
Yeah, I mean, the market doesn't know. Everyone, a lot of these tech leaders, when asked, how much should you be spending on CapEx in this regard, the answer is just more. And so, you saw some of this, turn of the century, right? The infancy of the internet. And who knows how it's going to play out over the long run. This is a very positive tailwind for infrastructure, which is oftentimes investment, right? It's kind of the needs to power all this energy. We have that as part of our core portfolio recommendations. Even what we focus on tax credit specific infrastructure last year is the example, made over 20% on a tax adjusted basis for our clients in New York, clients in California, higher tax brackets. And so obviously a lot of momentum, but who knows how it's going to play out, right? And it does seem like the leaders pushing to be at the heart of it, that will be kind of a winner take all game. I mean, the benefits beyond that, who loses that might lose spectacularly. Some of these companies might not even be around in a couple of years. I just love that this spending is creating tremendous benefits for the rest of us, right? To become more efficient. The creative plans of the world and helping us be more productive. And that's what you're seeing. Talking about oil right now, a lot of why it didn't spike as much as it did is that when oil was super expensive, a ton of spending went into it to find better ways to extract it because they saw this huge opportunity. Now, a lot of those quote unquote wildcatters disappeared, but the net effect of this massive spending was a tremendous positive. And we're actually seeing it on the relatively less movement we saw in oil than it would have otherwise been if that spending hadn't occurred.
Do you think the limitation here is going to come about because of the energy constraints, or is it going to be economic constraints in terms of they just don't have the cash flow, Jamie, and they have to borrow and the borrow rates go up? Or is it going to be some combination, or is it going to be pushback from individuals? We're starting to see more of that where they don't want this in their backyard because it's driving up electricity costs, and there's other fears about it's now crowding out maybe home building, these data centers. So what's going to be the limitation here in terms of growth?
Yeah, it could be any of those. I was recently in Washington, D.C. I didn't know, like that area of Virginia is like the mothership of data centers. I said, wow, I feel like Kansas might be a little bit less of a premium on land, but yeah, people are starting to not want these things to be their next door neighbors. They're not quiet next door neighbors. But the idea is, what's going to stop it if it stops? Could be just a whole host of these things. Really, what will hopefully innovation and being able to do these things more efficiently will actually solve a lot of that, for us, right? That was the movement we had that was larger in stocks with some of the things that Anthropic came out with to, make us more efficient, kind of some of the SaaS companies pull it down. That was just the idea of they're just a more efficient way to do things. And so hopefully there's someone in their dorm room, hopefully there's someone in their parents' basement coming up with the next wonderful idea to do this stuff more efficiently. So a whole host of things could end it. I'm hoping actually that the solve is just evolution, technological advancements within itself actually solve some of it.
Yeah, a lot of different moving parts, a lot of questions here. And we talk about efficiency, and I believe everything that you're saying. But to me, that also calls into question, Jamie, this investment should become cheaper as well, shouldn't it? At some point? And NVIDIA getting 60+% profit margins, that shouldn't continue forever in an efficient, competitive market.
And it won't. The laws of gravity always kick in. And this is a key for investors, right? This is, you say, are we in a bubble? Like, right, some of these trend lines would say we are. But that's always been the case when we've had these quantum leap forward, right? A bubble formed around, the internet, bubble formed around railroads, bubble formed around industrial revolution. So it would be abnormal for that not to occur. But take, the internet, right? You could say that's the closest cousin. Cisco, kind of some similar trend lines to NVIDIA. Well, the prudent investor is up 500% since then. And so that bubble came along, that bubble burst. And so it's the price of admissions. It's nothing new that we haven't experienced previously with all these other technological innovations that in the long run have been proven out to be a net positive for all of us.
Absolutely. What I've been saying, Jamie, is just assume it is a bubble and just make sure your portfolio is diversified enough where you could withstand that, similar to what we saw in 2000. Because even if it is, we don't know when it's going to burst. We don't know. It could go up a lot more before it goes down. There's so many different scenarios. You just want to make sure you have the right asset allocation in the event that something similar, and it's never exactly the same, in the event that something similar takes place as what we saw back then.
Yeah, people usually they lose a lot more money worrying about when the bubbles might burst than the actual bubble bursting itself. And this is why you don't put all your investments into this. You let your portfolio participate in it based upon global market cap weighted dynamics. So you get to ride it up, but you're not beholden to it.
And we're already seeing the benefits to that this year, looking at outperformance from small and mid caps, from international. The Mag 7 names are all down as of the end of last week. So it's not hurting you. This is the first time diversification's working in a long time, and investors are starting to appreciate, it's good to have some other things in my portfolio. I want to touch on the U.S. consumer here, Jamie, because pretty important, right? We had GDP growth around 2% last year. Many were predicting higher numbers, but came in at 2%. And what's driving that, like most years, is consumer spending. If we look at services and goods and add them up, that's almost 2%. You had net exports, you had federal government detracting, residential investing, housing. We're not going to touch on that today, but that's still detracting. So consumer, we all know, is pretty important. Over 70% of growth tends to come from consumer spending. And we're starting to see some cracks here. I've been highlighting this chart for a while. Each quarter, this is updated data from the New York Fed, but highest credit card delinquencies we've seen since 2010, 2011, around 13% now. Balances 90 plus days delinquent. Auto loans, similar situation here, a little over 5%. Student loans, you could see the spike higher on this chart after the resumption of payments, after they were paused for a few years. What do you make of this here? Obviously, this isn't everyone, but there are certainly people within the U.S. consumer segment that are starting to feel some pain here, as evidenced, but they're just not able to make their payments here.
Yeah, it's a real shame, especially people, the predatory, practice sometimes, the insanely high rates people can pay on their credit card balances, and that disproportionately impacts people at lower socioeconomic levels. Just like a spike in gasoline, disproportionately impacts people at lower socioeconomic levels. So that's a real shame, and you don't like to see that tick up. As Charlie mentioned, you and I out there spending money is kind of the backbone of the economy, and so these are cracks, right? And the student loan reformation is kind of just getting back to that trend line, but more broadly, this is absolutely worth monitoring. But overall, consumer balance sheets still look pretty good. Corporate balance sheets still look pretty good. They're kind of at the at the expense of government balance sheets looking like a dumpster fire, and that's an apolitical statement, right? There's been plenty of different political regimes that have driving towards that. So yeah, you hate to see this tick up, but you more so hate that it's disproportionately damaging people that are just really, really struggling to get by already.
Yeah, so it's a small percentage, I would say, of the overall U.S. consumers. As you said, if you just looked at overall, consumer delinquencies, you'd say, okay, this is nothing crazy. If you looked at the household debt, let's say, as a percentage of income, it's still very low. Most of that is just because mortgage debt is very low, and that you can see that on the chart here. Delinquencies among mortgages and home equity lines still very, very low, but what I would say is for the lowest income segment of consumers, that's where you're seeing the pain. And in my view, it's because of the cumulative inflation picture. And what happens, Jamie, the hard part here is what happens when inflation is higher. Let's say it's been averaging over 4% per year over the last 5-6 years. When that kind of compounds on itself, there's not a lot of money left over to save. So we're seeing saving rates go down, which is not what you really want to see here. We saw it back in 2022 as well when we had that inflation spike. So the latest reading we have here is around 3.6%. And, we encourage most people to try to spend as much as possible. 10% is kind of a good baseline number. But clearly, this is, to me, is indicating some stress. And then we have retail sales data, the most recent data, showing a decline in terms of the rate of change here. They were up 2% year over year on a nominal basis, and adjusting for inflation, slightly lower. So nothing huge so far, Jamie, and we'll revisit this, let's say, in a few months to see. But certainly, I think it would be hard to just dismiss this and say everything's fine within the U.S. consumer.
Absolutely, yeah. There's everything's not fine, and as mentioned, it's disproportionately impacting people that have the least amount of wiggle room, and you hate that. But yeah, very, very much something worth monitoring.
So what I'm going to be watching too here is the impact on travel. Travel's been a segment, Jamie. It's been very resilient. There was all that pent up demand after COVID, and I think some people are calling it revenge spending. And we just saw a boom, and that boom continued way longer than anyone anticipated. And this year we're seeing interesting thing. And if you look at consumer staples doing well, and part of this is just people positioning to more defensive areas. Look at staples up about 10% this year. So companies like Walmart, Colgate, Procter and Gamble, and you got discretionary stocks within the space down 3%, and airlines down 8%. Part of that is fears over Iran and higher oil prices, and that likely to hit travel, perhaps if it continues. But this will be something that I'm going to watch pretty closely because has been the strongest segment for a while now. And of course, if you're saving less, Jamie, and you're strapped, like we saw it first at the restaurants. We saw lower restaurant spending. I've been talking about that. And then maybe the next thing you kind of look to cut out is that discretionary travel.
Exactly. Well said.
Okay, let's talk about the Fed here because I want to get to a positive segment as soon as possible here. Let's forget about the rate cuts. Tell me why I'm wrong, Jamie. The last CPI report showed declines in fuel oil and gasoline. This was a January report. The overall inflation rate come down to 2.4%. If these oil prices and gas prices stay elevated, this is going to flip. This is going to show a positive year over year number for March if these prices hold. And what that is going to do is put upward pressure on CPI, which has been above the Fed's target now for 58 consecutive months. It's been above the 2% target. If gas prices this week hitting $3.25 a gallon nationally, you could see the red line here going above the blue line. The blue line are last year's prices. And for the first time in a long time, we're up year over year. That's going to put upward pressure on prices. And we have the Fed. It's already cut 175 basis points. We're at 350 to 375. And the market coming into the year was betting on 2 rate cuts, Jamie. And of course, we have the Fed chair Powell is going to be leaving, assuming he does leave in May. We have a new Fed chair coming in, Kevin Warsh. An interesting thing, what we've seen, Jamie, in the past few weeks is a shift higher in terms of expectations. Now the market's only betting on 1 rate cut this year. Of course, this can all change. And my view is that there's going to be a big fight within the Fed come June when Warsh is the new chairman. You have Mirren, you have Waller, have been consistently voting saying the Fed should cut rates much more aggressively. We believe that Warsh is going to say the same because he's been saying that publicly, and that's one of the reasons why President Trump picked him. But you have 9 other members in the Federal Reserve who are likely to say, let's hold the line. So very interesting. I think that you're going to see the most dissents voting against the action that we've seen in a long time.
Yeah, those are 3 tough tasks that Kevin would be assigned with, dealing with any of those for anyone.
Shrink the Fed, tame inflation, and manage the president.
Yeah, but the key is, as you mentioned, yes, that makes sense. If gasoline continues to be elevated, if we continue to see military engagements, but the key word in all that is if it occurs, and the Federal Reserve is really good at getting it right in the short run. What's going to happen? Their crystal ball is as utterly worthless as any of ours, actually oftentimes worse over the long run. And so if this does maintain itself, yes, it was lower gas prices were a tailwind. They were positive in lots of ways, right? Because then people lower socioeconomic levels spend a disproportionate amount on gas as well. So there's so many implications involved there, but it's an if, right? We might, next time you're recording this, Charlie, President Trump might be, singing in a kumbaya circle with the new leadership of Iran. Probably doesn't happen, but we never know. The future forever remains unwritten.
Yep, for sure. And so what I always say is just look at the next meeting. The next meeting's in 2 weeks. Market saying no chance of a rate cut. I think that's pretty much a done deal at this point. I don't think Powell wants to go out with any more rate cuts. So he has 2 more meetings, March and April. Just forget about those 2 and then look to June. So all eyes are going to be in June. And right now, market's saying 65% chance Fed does nothing. But as you said, there's a lot of ifs there. If oil prices come back down, a lot of moving parts. We're going to get a lot more inflation prints between now and June. So I wouldn't put anything on that. But I do think, Jamie, the idea of absent a recession, absent some pretty bad things going on economically, the idea that Warsh is going to come in and he's going to aggressively cut rates down to 1% or below, like President Trump has been calling for, I don't think that's possible absent a real crisis.
Yeah, there's tremendous political pressure on the Federal Reserve to lower rates, but people think that's something new with Trump. No, Jimmy Carter blamed the Federal Reserve for losing to Reagan. Richard Nixon blamed the Federal Reserve for losing to Kennedy in '60, and Andrew Jackson, physically detonated the Federal Reserve. And so this is nothing new to have that political pressure. The current state of inflation, if oil stays elevated, sees that a more difficult task. But the idea is, yes, using myself as the example, I feel so fortunate. I get to do a lot of different things, meet with a lot of amazing people, analyze a lot of different investments. I'm pretty sure what tomorrow looks like for me, but I have no idea what's going to be happening several weeks from now and what I'm going to be focused on. And that's, the Federal Reserve is really good at knowing what's going to happen tomorrow or next couple of weeks. They have no idea what's going to happen in the future because they have no idea what what inflation is going to be giving us.
That's true. And just looking at the past few years, Jamie, the best thing I could say here is that the Federal Reserve, maybe at some point in time, the Fed cared about inflation, but they don't really want inflation to be 2% if they're cutting rates so aggressively with 4% per year inflation over the last 5 years. You could take that in many different directions, but I don't think the Fed has any credibility in terms of here's our target and we're going to implement policy to try to achieve that, because they basically have been ignoring that over the past 5 years.
Yeah, I would definitely say you fall strongly into the Andrew Jackson camp of how to deal with the Federal Reserve.
100%. Okay, let's end with something positive, Jamie, as we always do here. Falling homicide rates. Here's a fascinating chart here. This goes back to 1900, looking at homicide rates within the U.S., and we hit an all-time low in 2025, 4 per 100,000 residents, lowest level data going back to 1900. A lot of people saying different reasons for this. I don't know who to believe, what to make of this, but if this number is accurate, 100%, it's a great thing, and hopefully it continues.
Yeah, I mean, this is awesome, and for any Elvis fans out there, I know there's the new concert series of some things that have never been seen before, and as he said, it's, if there's one less mother crying for a tragedy befallen her sons or daughters, that's nothing but an absolutely amazing and wonderful thing for everyone. Probably the best statistic I will see in a long, long time.
Great. Glad to provide that, and no better way to end than that. Thank you, everyone, for joining us on the Week in Charts. Have a great weekend. If you're watching this on YouTube, hit that subscribe button. Jamie, always a pleasure. We'll see you soon on the Week in Charts. Thanks, everyone.
Thanks, Charlie.